Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Fed Week and how the Fed meeting could impact mortgage rates. Before we jump in, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah, in very freezing Indiana again. I'm going back to Orange County where I belong, but
this is why you look like you're like Nanook of the book. You're like,
this is my Game of Thrones outfit. This is that, when I went to Japan many years ago, people kept on taking pictures with me because I had something like this on, and they go, Jon Snow. And I'm like, no. I was in the chart daddy then, so it is what it is.
It is what it is. Okay, on this note, we just have to one more time check in on your Stranger Things viral, and I mean mega viral post that you did where people thought you were part of the Stranger Things crew. Where did you end up?
I think I'm at 11 million now, so I broke into Brazil now. So it's always fun, like looking to see where countries and everything, and India, Brazil, Mexico, Japan, US, but that's been an interesting experience.
That is crazy. Okay, well, let's talk. We have some important things to talk about. Fed Week. Oh my gosh. Okay, what's the preview here?
So just like the last time with the Federal Reserve, mortgage rates near 6%, Fed is nervous. Right. We've documented this since the early part of 2023 because of their words. I think Neil Kashkari, when he said that, how are you supposed to balance an economy if the housing market shows a little bit of life? And it goes into I know people think I'm joking, but if more people have sex, they have kids, they buy single family homes, if we start building homes again, these things make it difficult for the Fed to kind of suppress economic activity. So this is the one sector that they control. So usually when we get about here, they get hawkish. Powell got very hawkish. It probably cost Christopher Waller the Fed chair job. We had a lot of hawkish Fed presidents who were kind of wrong about the labor market this year. So you're going to get a cut, but I think they're going to sound very, very hawkish. Pretty much maybe even saying, hey, listen, unless things get worse, we're done. But they kind of said that last time. So a rate cut, but probably maybe the most hawkish Jerome Powell has been in recent history, because most likely this is his last Fed meeting before they announce Kevin Hassett as the next Fed chair. And then, the verbiage is all going to change after that when Powell leaves the Fed chairman job.
I just think, if you look at the data, we went over it in our last podcast, the jobs data is not great. Is it breaking? No, but it's not great.
I think one of the things that, for example, the Challenger job cut data, economists don't really look at that as big net volume value.
What is the Challenger data?
The Challenger job cut, they come out, weekly with announced layoffs. And one of the things I probably should have done this maybe earlier in my career, that 1.5 to 2 million people lose their jobs every single month. So there's the natural flow of discharges, and then there's the economy's slowing down, growth is slowing down, private investment, domestic investment is slowing down because growth is slowing down. There's no more hirings, and now companies have to lay off because margins are being hit. These are two different things, and the labor market is getting softer for some times. But as we've always said, they need to see the labor market break, right? Okay. They need to see jobless claims break. They need to see growth slow down. They need to see industrial production. They need to see retail. So they need to see all these things before they want to make that next step forward. So I do expect a very hawkish Jerome Powell, and for another wave of very hawkish Fed presidents who most likely will be targeted by President Trump next year.
Yeah, we talked about that in our last one, that now they're being targeted. Well, let's talk about this week, what you think that rate cut means for mortgage rates. Anything? Are they actually going to go up as a result?
Well, so much of rate cuts heading toward neutral has been priced in. For example, last year, the 10-year yield broke the Odor line And I was like, wow, if we don't get into a recession very fast, boy, the 10-year yield is just should shoot right back up. Now, bond trading is a little bit more disciplined this year. So it's been correct, heading itself lower. It hasn't gone too extreme lower to have like a big shoot up. And we're saying this because, it's December, and last year at this time, mortgage rates were near 7% because the 10-year yield already shot up. We don't have that because we have rate cuts into the system, and we also have the labor market getting softer. So it's a much different backdrop. I know a lot of people thought, well, here we go again. They're going to cut rates and the 10-year yield is going to shoot back up and mortgage rates are going to go above 7% again. And that didn't happen because the curve of the Fed fund policy is lower. So naturally, the 10-year yield and everything. Last year was different because we had no rate cuts into the system and they went straight 50. As Jerome Powell said, they probably waited too long to do that first cut. So they did 50 instead of doing 25 to 25. Now you have rate cuts in the system. Now you have the labor data get softer. Remember, last year at this time, November and December jobs reports were averaging 262,000 plus jobs, the 2-month average. Okay, so the last 5 months have been averaging 39,000. That is that's big. That's material. So not much of a reaction, but typically how hawkish Powell wants to be, bond yields typically do go up, but we're kind of in the lower end range of the year. Now, if the labor data starts to improve, right, that's the thing, you have a little bit ways to go up higher, but not like what we saw in the previous year. I think the previous year was one of these things where we just got into the rate cut cycle and we're cutting rates. So, we had a lot of leeway to go up. It's a little bit different now.
So, I know we've talked about this a lot, but it's still confusing to me why Powell thinks that going from 280 whatever thousand jobs down to 39,000 jobs is completely fine in a year. And when you say if jobs improve, if labor improves, but it's like, but aren't we at this really bad number, or is he looking at a totally different metric?
I would say they're placing a lot of the blame on labor force growth. So in their minds, when Jerome Powell said zero job growth to 50,000 is acceptable, right? That's acceptable. If we created 1,000 jobs per month in that framework, it's acceptable because population growth has slowed down. That he doesn't believe that the U.S. will ever be able to produce large job numbers again. We just don't have the labor force growth anymore. If you look at the labor force growth, the supply of workers and the demand for workers, we're kind of pretty much balanced. Where after the great financial recession, we had a lot of slack, right? Wage growth wasn't really rising up or picking up because we had so much labor supply and not enough demand for it. Here, we're in their minds, they look at it as we're a balanced economy on the labor side. But I think some of them are falling back. Well, wage growth is not accelerating, it's decelerating. That's when the labor market's getting softer. And of course, there's sectors of the economy, especially contractor construction jobs being lost, manufactured jobs being lost. It's typically never a good thing in the cycle where manufacturing and construction workers are losing. But again, a lot of deficit spending. We have the AI boom that's kept construction workers building. So there's a lot of things going on that's specifically unique to this cycle. So they look at it as now, Powell admitted, the labor market's deteriorating. You have other Fed presidents who I think the confusion people get is these Fed presidents are almost in a sense talking too much, so it's very conflicted when one person says robust and then the Fed chairman says deteriorating. And then that person who said robust 2 weeks later says, okay, there might be some problems. It's a little bit too wishy-washy. You can maybe get that from a fake person, but you expect a little bit more stability. And I think there's just so many people that did not want to cut rates. They had 2 rate cuts kind of priced in for the year anyway, but they didn't want to go anything more than that because their inflation numbers hit their targets. And I think that's the thing. If the growth rate of inflation was near 2%, they wouldn't sound as hawkish. They wouldn't be cutting anymore and more than usual, but they wouldn't sound as hawkish as some of them have.
Okay, so we are recording this on Friday morning, but this will go live on Monday morning. So this week, the week of the Fed meeting, what data will we get that might move the needle?
The data is kind of just it's kind of in there already. There's not really much because the big reports come after. You take all the data in the aggregate, it's just the same thing: softening labor market, but not breaking. And how the Fed really looks at that. I think this week you had jobless claims under 200,000, right? But you had multiple other data line sets that were negative. So it's one of these things. Which do you believe in? I think the Fed will feel a little bit safer when they have the BLS jobs reports coming in, but some of the other data lines are just saying the same thing: softening labor market, but not breaking. When the economy breaks, growth slows down, consumption slows down, investment slows down, industrial production, wages, these things typically all come down together. So they look at it as, okay, it's not there yet, so we can still work our way to neutral policy, but it keeps sounding very hawkish. I mean, we said this last Fed meeting.
I feel like we've been saying this forever.
They could take a layup, but they probably won't. And what did he do? He went hawkish, and now most likely Kevin Hassett will be the next Fed chair, and we won't see that hawkish tone ever again as long as Trump is president.
Okay, well, everyone's watching, of course. We want to know what's going to happen with rates and mortgage rates. Okay, let's talk about tracker data. What do you think is going to happen here?
So here we are toward the end of the year. In the end of the year, weekly contracts, new listings, active, everything starts to drive itself lower like it usually does at the end of this year. So right now, purchase apps are probably the most useful thing, but also our pending sales data, because our pending sales data, again, at 30 to 60 days out, it looks. So we've seen a deviation right now, even from 2024, where some of the pending home sales were deviating from other levels. So we just want to kind of keep an eye on that going into 2026. And then when we go into 2026, what do we know? The last 3 years have showed us when rates stay near 6%, it can work. It doesn't mean that home sales are going to go booming or anything, but when you stay at a lower curve for a longer duration, we've never had that in the last 3 years. We've always had rates get down to 6 and then they shoot right back up. They don't just, slow, they shoot right back up. And if that's not the case, we just want to keep an eye on kind of how that weekly and total pending home sales data and how purchase apps act. So obviously it's been a surprise for some people the last 2 weeks having positive weeklies and year over year. Still year over year is double digits, 17 and 20% back to back with harder comps. So just kind of keep an eye into that going into the rest of the year. And of course, the last 2 weeks of December, you're going to see people go, oh my God, no one's buying homes. No, it doesn't matter what rates are. It's the last 2 weeks of the year. So the data volumes always, that's what happens every year, and people make too much of it. But again, around holiday weekends and timeframes, you have to be a little bit mindful of weekly data, and then gear yourself up for 2026. Much different than last year. Last year, I think we're near 7% rates. Bond yields are shooting up higher. Not the case this year.
Not the case this year. All right. Logan, thank you so much for being on. Talk to you again soon.
Yep. Back to sunny Orange County.
Where you don't look like you're about to go into the Arctic or something. All right. Thank you.